The Retirement Cafe podcast, the 9 accelerators for a successful retirement. Minimising lifetime tax. Hello and welcome to another episode of the Retirement Cafe podcast with me, your host, Justin King. If you're thinking about your retirement or already retired, you're in the right place. My aim is to help you plan for and live a successful and meaningful retirement. Retirement is far more than just a financial event. It's a significant life event, a major transition, which will bring with it new challenges and opportunities. So each episode contains tips, information, and inspiration to help you feel more informed and confident about your retirement. I hope you enjoyed today's episode. Hello, and thanks for joining me on the podcast. This week's episode is the third in a series of 9 episodes all about what I call the 9 accelerators for a successful retirement. If you missed the first 2, you can find them on our website at theretirementcafe.co.uk or on your preferred podcast player. You'll also find links in the show notes to this episode. If you've been following this series, you'll probably know by now that when I'm not recording podcasts, I run a retirement planning business, MFP Wealth Management, helping people retire successfully. Over the years, I've helped dozens of couples plan for their ideal retirement. And during this time, we've created a framework for what we believe needs to happen for people to be able to retire with confidence, clarity, and choice about how they spend their retirement. We call this framework our Retirement Success Program, and it contains 9 accelerators. These are the areas of planning we consider with each and every client when helping them plan for that next stage of life. The aim of this podcast series is to help you identify any gaps in your own retirement planning. So far, we've discussed the importance of identifying your priorities for your retirement and the benefits of creating a lifetime financial forecast. Today, again, my wife and business partner, Kathy, will be sitting in the interview seat as we discuss minimising lifetime tax. So welcome back to the podcast, Kathy.
Hello, it's great to be here.
So we're going to talk about tax.
We are, everyone's favourite subject.
Absolutely. Well, I'll hand over the questions to you. What do you want to know?
Okay, so the first thing is really, I suppose, is to understand why is understanding your tax position so important as part of retirement planning?
Well, I think that people would like, most people, again, not all people, but most people would like to minimise their tax. They don't mind paying their tax, the right amount of tax, but they don't want to pay £1 more than they need to. So they want to take advantage of the opportunities and the allowances that are available to them.
Well, that makes absolute sense, doesn't it, I suppose? And, you know, obviously you deal with a lot of people as they're approaching their retirement and helping them planning. And so what are some of the kind of common questions or concerns that people have that you're dealing with?
So we've got to break it down into a number of aspects, and I suppose it depends on the client that we're working with. So it depends on their financial position. Of course, everyone's financial position is individual. So this is not advice. This is just a generic conversation about. Please don't act on anything you hear on today. You know, talk to an advisor yourself. But so around pensions, for argument's sake, so pensions are very tax advantaged in the UK, and therefore can further contributions be paid? What are the limits that people can pay in to get tax relief? Is it worth exceeding the limits? Sometimes it can be. Is there what are the tax reliefs going in and what are the tax reliefs coming out? Yeah, and also it gets even more complicated with annual allowances and lifetime allowances, which are it's the maximum amount of money or investment funds that you can hold, the value of them before you suffer further tax charges because you may have exceeded the lifetime allowance. So, I can't go into all of that today, but even just around pensions, it's complex. And then, of course, people may have let properties. so that there may be income coming to receive from there. At some point in the future, they may have a state pension coming in. Does that affect the tax allowances? So, there's a lot to play for here to get it right.
So how do you kind of get all of that information together? What's the best way to get I suppose, a comprehensive view of your tax position? When you've got to consider all these different types of tax on different products or different investments that you hold, how do you see it all in one place?
Yeah, it is. It does sound complex, but I suppose it's a bit like going to your doctor for the first time. Let's say you have never met this doctor before, and for some reason you need a full status report on your health. The doctor will do a medical on you and will ask a number of questions and take a number of readings. We do something very similar. We basically ask the client for all their financial information, and then what we also want to account, of course, is not just their current position, where are they today, but what are the future income streams or capital gains that they might make or inheritances they might have, so that we can build, as we mentioned before, a cash flow forecast which brings all those income streams or investments coming into the plan, so we know when they're going to happen and then the most effective time to maybe take them.
So there's also, how to best phrase this, but some people talk about tax avoidance and some people talk about tax mitigation, don't they?
Yeah.
So what's the difference?
I think avoidance is really about just not probably paying the right level of tax or what you're due to pay, and if someone was paid, you pay someone in cash in hand and they're not going to disclose it to HMRC, but maybe that's tax avoidance. Therefore, the clients we deal with are really quite happy to pay the right amount of tax and the relevant amount of tax. It's just that they don't want to pay too much. So they may house investments in an ISA. I mean, you could say that's tax avoidance, but it's actually, this is a government scheme, so we would view that as tax mitigation. You could hold a £20,000 investment not in an ISA or in an ISA, and in an ISA is going to be more tax effective. So that's what we would do. We're allowed capital gains tax allowances each year. So if we've made gains on property or we've made gains on shares, we try and utilize that allowance each year so that we don't have it all at one hit. I mean, that's kind of the traditional problem with property, really, or second property. We don't pay capital gains on our own residential, private residence at the moment. Well, I do say at the moment. This is recorded prior to the budget in 2021, and who knows what's up for grabs. But if people can time capital gains alongside losses sometimes, so they can offset losses against gains. So again, it's a very personal situation, and looking at, we've got to have knowledge of all the different taxes, all the different tax rules, and then the interplay of all these different investments or products as someone goes through retirement age, and of course onwards, and up until their final death, when we have even more taxes come into play.
So there's a lot of different taxes to kind of wrap your head around, aren't there? And I suppose, you go through your working life, and we're all familiar with income tax, so that continues. But obviously the rules change, I think, don't they, as you kind of get into retirement? There's some of your income is taxable, perhaps some is exempt from tax. Is that correct?
Yeah, I mean, usually, depending again where you're getting the income from, but retirement income, pension income doesn't have national insurance, for argument's sake, deducted. And if you view national insurance as a tax, which I must admit I do, then your retirement income from pension providers, so that could be from a defined benefit pension, a final salary pension, or it could be your state pension, or your personal pension arrangements, that they wouldn't suffer national insurance. So there's some flexibility around that. And of course, if you retire or finish work prior to prior to getting your state pension, there are a number of flexibilities of the tax kind of opportunities there. So you could be withdrawing from your pension and utilising all your personal allowance. So that would be the personal allowance this year of £12,500 and possibly some extra tax-free cash. You're also eligible from a pension scheme. So you could have £16,500 worth of tax-free income which would fall within your personal allowance. So that may be worthwhile, in essence, front-loading before you get your state pension, because your state pension then may take up most of your personal allowance. So there's always kind of opportunities. And then obviously, has your spouse got maximum pension rights? Is it worth, your ideal, I suppose your kind of tax nirvana would be to have fully utilised your pension contributions during your life. Maybe you're a higher rate taxpayer and you would be getting 40% tax relief, possibly even more, depending on whether personal allowances have been deducted and things like that. But contributing fully to pensions, contributing fully to ISAs, and then when you get to that point of financial independence, the point of opening those taps, if you haven't got all the income falling on one of the partners in a husband and wife situation or a civil partnership, if you've got kind of a dual income coming in, that would probably be most tax effective, because of course you both got your personal allowances. So, and then you've both got a dividend allowance of £2,000, and you at the moment you can hit, it's over £50,000 before you hit higher rate allowances. Whereas of course, if you're only paying one partner, I don't know, let's say £120,000 a year, and you're paying the other partner nothing, that's not as tax efficient as paying £50,000 each or £60,000 each or what have you. If you could equalise your income out, I know for ourselves, that's one of the things we do. We contribute equally to our pension plans. So therefore, when we decide that we want to start drawing down on those pension plans, we're both going to suffer tax. Where if I had it all in my name and was contributing everything into my name, that wouldn't be as effective.
Yeah,
tax efficient.
Tax efficient. Yeah, it's all about efficiency, really, isn't it?
Yeah.
Being really efficient with your tax planning is effective ultimately, and you have ultimately more money in your pocket.
Absolutely, and and looking at the lifetime of the tax, so it may be just good for 1 year is not as effective. Actually, looking at the lifetime cash flow and going, okay, so actually what happens on, what's the withdrawal mechanism now? Are we better off with, if let's say a family has got would have an inheritance tax liability at some future point, are they better off maintaining investments and savings within their pension funds, which are currently without inheritance tax? This is a private pension arrangement, not a defined benefit or final salary, but with a cash value, and that you've completed an expression of wish on. So you've told your trustees that you want it to go to your spouse or maybe to your children, and currently that would pass tax free. That would pass as the pension fund. Your spouse or your children, or actually anyone else, to be honest, whoever you were nominated, could receive those pension benefits. I mean, that could be an amazing gift to your children or even grandchildren, that they would inherit a pension plan that you didn't spend all of, and it wouldn't suffer inheritance tax. So choosing the right way to withdraw down on the savings and investments that you've acquired over the years is, again, a real consideration.
It is you mentioned the word lifetime. That's crucial in this, isn't it? Because I think all too often we just look at the current situation we're in, don't we? The current job that we're doing, the current tax that we're paying, and not necessarily take that much longer view, which might result in different decisions. Yeah,
I think we just got to go with our eyes wide open. And again, you might think, I take my pension at 65 and I get tested against the lifetime allowance to see whether I've exceeded that. but if you don't take your pension, it'll be tested again at age 75. So depending on the growth that you've had in that pension fund, you may further a further tax bill that you weren't expecting. So these events are called benefit commencement events, and there's a number of them. And again, I won't go into the detail today, but again, it's just that kind of consideration of like, okay, well, if I've got this value today, what's the likely value will that be in the future? And therefore, okay, should I spend a bit of that, or should I spend the growth, or should I spend some income out of that, or what is the right call? And often it's not you can't just provide a flow chart which says if you do A and then B and then C and the answer is obviously D. Everyone's circumstances are different. Their family circumstances are different. Their lifestyle in retirement is going to be different. So you've got to kind of mold this plan bespoke to a family's life, and of course not everyone knows exactly how that's going to pan out of a 30-year retirement. So it's a real key consideration.
It is. So but because everything, each person's plan needs to be bespoke to them, are there still a kind of like a series of questions that you've just ruled off a whole host of different questions you could ask yourself? Are there kind of a series of questions, simple questions maybe, that people can ask themselves to I guess garner where they're making the most of certain tax opportunities?
Yes, I suppose they can. I mean, the key factor is if we were taking a step back and just going, okay, so someone may be listening to this thinking, right, I probably, I'm planning on retiring in the next 5 years. Am I making the full use of all tax reliefs available now? Am I and my spouse making opportunities of independent taxation? So that we in essence, everyone's desire is to save enough in their retirement savings, and that can be everything from cash in the bank to kind of just direct held investments, shares possibly. It could be ISAs, could be cash ISAs, it could be stocks and shares ISAs, it could be onshore bonds, offshore bonds, it could be inheritance that they're going to get in, it could be buy-to-let properties. But look at all of those things and then go, right, once I know all that, what are the income streams going to come from each one of those? And then also go, right, those are the income streams that are going to be taxable. What are the further taxes that might be payable later on? And they come back to this lifetime tax. So we might have a buy-to-let, which is great, and it provides a rental income, and we can offset expenses off against it and all this type of thing. Who owns it? Is it better to hold it 50-50, or is it actually better to hold it in one person's name? And then, of course, looking at the lifetime tax. So, okay, well, at some future point, we may want to sell that. What's the final capital gains tax bill going to be? Because that's the total cost of ownership or the total tax bill for that asset. So we were dealing with someone the other day with 26 properties. And they're in retirement, and they've got a defined benefit pension, and they've got their state pensions coming in. But these rental properties, of course, are they've held some of them for a long time, some of them not. Some have done well, some haven't. So actually, they do realise that they don't want to run a 26 property portfolio into their 80s and 90s,
Yes.
And therefore are just going, okay, so what is the right time to start de-risking ourselves and actually reducing the property exposure that we've got? And of course, what we can help them manage is go, okay, so which ones have made money? And if some of them have got a loss, is it worth creating the loss before we sell one with a gain, so we can offset that loss against the gain? So yeah, again, sadly, so I'll answer your question. You've got to become pretty aware. If you want to do this yourself, you've got to be pretty aware of what all these taxes are, and run those models. This lifetime tax as we talk about, this is the third accelerator, but it has to match that cash flow that we talked about before. So that's the key. When do you need the money? When do you want the money? When do you want to pass money on to your children? When's the best time to pass that on, or to grandchildren? So yeah, this intermingles with the first two accelerators, of course.
Yes, of course, they're all interlinked, aren't they? And so, you know, some people may want to do this themselves, some people might not. So if people listening decide they actually probably would benefit from getting some help, what should they search for? What kind of qualifications or experience should people look for? Should it be a specialist tax advisor or financial advisor? What's your view?
So I think financial planning, ideally, if you want a financial planner, get a certified financial planner. Ideally a chartered financial planner, but if they can have the additional qualification of certified financial planner as well, we can provide some links where you've got some directories of those advisors across the country. That's pretty useful, and because you've been tested to charter status, and because you've been tested to the CFP status, which is a global kind of qualification, that I would have fair surety that someone could put a good financial plan together and would have the technical knowledge to go with it. So the next key thing, though, let's say you've got a handle on your cash flow. So I've got an example of a client that we've worked with recently, and they've got a big defined benefit pension coming in, and that's their asset. So there's £80,000 a year coming in a defined benefit pension. Well, in essence, they're getting paid for the rest of their life, and 40%, 50% of that will go to their spouse on their death. So there's not much financial planning needed for someone like that. They know what it is already. It's index linked, fantastic. It's coming in, and the spouse is covered. So therefore, if they've got specific tax questions around, I don't know, let's say a second property or a capital gain they want to make, I'm a great fan of going and seeing a chartered tax advisor. Not an accountant, but accountants can answer these questions, but we deal with a really, really good chartered tax advisor on one aspect, who helps our clients put some really good tax mitigation strategies into play. Part of our professional network, as you know, we've got the key lawyers that we deal with. Again, one specific lawyer is a chartered tax advisor and a lawyer, so it doesn't get out much. Bless you, Kurt, if you're listening to this. But again, on the tax front, we've again got a really good guy, Graham, who helps us put some really good tax mitigation strategies into place. So it's knowing where to go for what you need, really. But again, because coming back to the DIY option, which is not a bad thing, even if you're going and getting second opinions from people like myself or these other experts that I talked about, is gen up a bit on it. So, and again, I can give you some. We can put some links into the show notes. And I've got some books on the bookcase here, which they cost kind of hundreds of pounds each year to provide the up-to-date legislation or the information about the legislation, about tax around trusts, tax about inheritance tax about business sales, and all the considerations around that. But if you go onto the HMRC website, it's well written nowadays. I mean, I remember starting in this business in 1986, and I'm showing my age now, and you used to read it, and it was just gobbledygook. But I find it really, the HMRC website is pretty well written now. There are still vagaries. There are still stuff that you just go, really? What does that mean? But for most people, they can find their answers on there. And even if you go and just gen up a little bit before you go in and hire an expert, I don't think that can't not help you.
Yes, absolutely. In fact, I was on the site this morning reading about the trust registration service, and I was quite relieved at how how much is written in plain English, how simple it is really to understand. So I would completely agree with you on that with regards to the HMRC website.
Yeah. And, I'm a fan of the Consumers Association, which.co.uk. They have, I subscribe to their money magazine or whatever it's called. I can't remember. But these are the good articles. I've got some pretty other specific stuff that I love. I love the Schmidt tax report. I haven't got one handy, but we subscribe to that. That's a few £100s a year, but that's kind of very entrepreneurial and thoughtful about different ways of structuring stuff. So, do I have a limited liability partnership? Do I own a property as a sole person, or do I hold it jointly? Could I put my house in my kid's name and pay them rent? And, it's got all those kind of, or shall I go and live in the Algarve where it's very, very tax efficient? Which I keep dropping into our conversations, but you haven't taken us up on that yet.
I'm tempted by the warmth, though. Tempted by the sunshine.
Very tax efficient for retirees.
Brilliant. So we'll pop lots of examples in the show notes then, so that people can have a little look and see what works for them. That's great. Okay, so we've talked about lots of different types of tax and things to consider. Is there any final words you want to leave us with regards to tax planning and
it's the old analogy: tax is taxing, and. There's an element, I don't know, maybe I've just become a bit odd really, but I think that as an advisor, we can really showcase our knowledge because we can look at someone's situation and then we can run the models and go, do you know what, actually a little bit of a tinkering here and a bit of a shift there actually has a dramatic impact over 20, 30 years. So being up to speed with tax is really, really useful. And I appreciate, we've got some very knowledgeable clients who work with us, but I think it's nice for them to rely on us to kind of go, you know what, Justin's read it. He will know what's going on with, I don't know, let's say, as you mentioned earlier, the tax registration, this trust registration service, that's what they're kind of paying us for, to wade through all that stuff that comes out of the budget. We've got one coming up to go, okay, so yeah, all this stuff's changed. What's the impact on my life? Like for that. Mm-hmm. So just to give you one last example, we were talking with a client, or I was talking with a client this week, and we were setting up a limited company to receive book royalties. He's going to write a book. Well, he's going to write a second book. And he also gets a number of speaking engagements. So he gets paid for that. He also writes in a magazine. And therefore, we are going to get that money paid into a limited company. And that limited company is also going to employ his spouse, because she does a lot of the kind of secretarial type of duties for him. So, she's booking him and sorting it. Well, when we used to be able to travel, sorting out flights and this and that, and just doing a lot of the work. So that limited company will now pay her. Well, that's much more tax efficient than him receiving all of that money. But the other question he asked me, and I think I've got to do the work into this to find out exactly how it's going to work, but he's going, so could that limited company buy me an electric vehicle? And it's like, well, yeah, it could. Well, is that better for me than running the vehicle through my, he gets paid at the moment for his salaried job. They don't provide a company car. So he's now thinking, well, actually, could my limited company provide me with a company car? Well, we will run the numbers on that, and I'll talk to because we deal with his accountant and we deal with his lawyer because they're part of our professional network, and I will go to them and I'll put this to them and I'll say, right, is this more efficient for him to buy the car himself through his own, through his family means, or is it better to put this through his limited company? And then we'll go back to him with an answer. So, and then you might say, well, what's that got to do with retirement planning? Well, every pound we save in his period before he retires is another pound we've got to spend in retirement. So it is critical.
Hence why it's lifetime, isn't it? It's lifetime, minimizing lifetime tax. And the sooner you start looking at it and planning it in that way, then the better.
Yeah.
Ultimately.
Yeah. It's probably not the most exciting of topics at a dinner party.
No, not so much.
But if you can be efficient with your tax, then it makes a difference.
Absolutely. Well, that's great. Thanks very much for that, Justin. We'll be back in a few more weeks' time with the next topic, the next accelerator. So right. I think that one's about a well-crafted investment. So we'll be back talking about investments on the next accelerator episode.
Fantastic. I look forward to it.
Good stuff. See you then.
Bye-bye. So thank you to Kathy for helping me explore tax today. I hope you learned something new or interesting. If you have any questions that have arisen for you as you've listened, please don't hesitate to get in touch and I'll do my best to answer or point you in the right direction. You can reach me on email at hello@theretirementcafe.co.uk or via Twitter at JustinKingCFP. Next in this series, as Kathy mentioned, is one of the accelerators for a successful retirement is the importance of having a well-crafted investment strategy. So be sure to subscribe to catch that episode when it's released. As always, if you've enjoyed this episode, please leave a review on Apple Podcasts to help more people like you find us, or share this episode with someone you feel who would benefit. So until next time, this is Justin King, helping you feel more informed in your retirement.